A bull market is a broad, or a single market in which prices are constantly rising. As a result, investors profit at any price at which they purchase an investment, because prices normally continue to climb. Before we reveal a complete guide about the bull market in this video, please take a moment to go down and smash the like button, and if you have not subscribed to our channel yet, what are you waiting for? Please do so and enjoy our channel. A bull market is the most desirable. However, if you are new to investing, it helps to understand what drives the bull market to take advantage of the opportunities available. Let's understand the bull market with the help of examples in modern American history. The most productive bull market began in 1982, at the end of the stagflation era, and ended in 2000 with the dot-com burst. During this secular bull market, a term used to describe a long-term bull market, the Dow Jones Industrial Average (DJI) averaged 16.8 yearly returns. The Nasdaq Technology Heavy Exchange, more than five-fold, increased its value between 1995 and 2000, going from 1,000 to over 5,000. A long-term bear market followed the 1982 to 2000 bull market, from 2000 to 2009. The market failed to find its footing, delivering yearly returns of 6.2 on average. However, 2009 marked the beginning of a more than 10-year bull market. Analysts believe that the last bull market started on March 9, 2009, mainly led by an upswing in technology stocks. So, how does a bull market work? A bull market often lasts until prices have climbed for so long that investors assume prices will continue to increase. Thus, investors' ideas about stock prices influence the prices themselves. In a self-fulfilling prophecy, a word used in investing that refers to investors generating market conditions, resulting in higher prices because investors are influencing the prices to rise when prices do not fall over time. Investors experience irrational exuberance. They begin bidding at prices well in advance of the fundamental value. Drastic overvaluing the investments. This leads to what is known as an asset bubble, in which prices grow until the supply of the assets opposes further price increases. Then investors panic and sell, causing the bubble to burst and prices to fall. A market correction is defined as a drop in prices of 10. Investors lament the end of the bull run at 20 as the bear market begins. Conversely, the exact percentages are used when prices begin to rise to announce the return of a bull market. There are some specific types of bull markets to be familiar with Type 1 stock. In most cases, all three major stock market indices rise at the same time. Dow Jones Industrial Average, the STIP 500, and the Nasdaq are examples of these three. A bull market makes higher highs and fewer lows on a consistent basis. For example, in a robust economy, a stock bull market occurs. A stock bull market is driven by three factors in addition to investor sentiment. Number 1, top-line revenue. This should increase as the economy grows, as measured by nominal gross domestic product and GDP. The output of goods and services at current prices generally reflects customer demand for products and services and GDP growth rates. In previous economic recovery, periods were 7.5, 5.6, and 5.2. It has only expanded by 3.7 every year on average since 2008. Number 2, profit. This is the earnings generated by a company's top revenue. Over the last 20 years, the average has been 7.5. However, during the economic recovery from 2008 to March 2020, a 9.80 top revenue record was achieved. When businesses can earn more profit from the same revenue dollar, it looks to be positive for the economy and consumers. However, this is not the case. This profit is made at the expense of jobs, salary cuts, and capital investments. Number 3, P ratio. The price-to-earnings ratio is the ratio of a stock's price to earnings per share in dollars. Investors tend to follow the PE ratio for their investments. As earnings begin to fall, the PE rises, forcing investors to sell their assets. Second-time gold prices reached a new high of $1,895 on September 5, 2011. This marked the end of a gold bull market that began in 2000. Prior to it, the price of gold was frequently around $300 to $400 an ounce. Wait. Hold on, guys. If you've enjoyed the video so far, please give us a like, and don't forget to subscribe to Financial and Investment Wisdom, and type your insights in the comments section as you're watching this video. Third-time bonds. Bonds have been bullish since the mid-1980s. This means that investors have not lost money when buying a bond because their rates of return were always favorable. The Lewis Federal Reserve indexes all show positive returns for this time period. Some came dangerously close to zero returns, but none crossed the line. A bear market is the inverse of a bull market, marked by falling prices and generally veiled in pessimism. According to popular opinion, the use of names, bull and bear, to describe markets come from how animals attack their opponents. A bull raises its horns into the air while a bear sweeps its paws downward. These actions are analogies to market movement. A bull market exists when the tendency is upward. A bear market exists when the tendency is downward. Bull and bear markets frequently correspond with the economic cycle, which comprises 4 phases: expansion, peak contraction, and trough. The start of a bull market is frequently an early indicator of economic expansion because stock values are driven by public emotion about future economic conditions. The market frequently increases before broader economic measures, such as GDP growth, begin to climb. Similarly, bear markets typically emerge before an economic recession takes root. A typical US recession is marked by a declining stock market that occurs several months before the reduction in GDP. So how to take advantage of a bull market? Let's see. Investors who wish to profit from a bull market should buy early to capitalize on rising prices and sell when prices have peaked. Although it is difficult to predict when the bottom and up will occur, most losses will be minor and usually transient. After that, we'll look at some of the most popular tactics investors use throughout bull market periods. However, because it is hard to gauge the market's current status, these tactics carry some level of risk. Number 1. Buy and hold. The ability to sell a security at a later period is one of the most fundamental techniques in the process of purchasing a specific asset and holding on to it. This technique necessitates the investor's confidence. Why hold on to security unless you expect its price to rise? For this reason, the confidence that comes with bull markets tends to drive the buy and hold strategy. Number 2. Increased buy and hold. Increased buy and hold is a variation of the short buy and hold strategy involving additional risk. The premise behind the increased buy and hold approach is that an investor will continue to add their holdings, in particular security, as long as it increases in price. For example, one standard method for increasing holdings suggests that an investor will buy an additional fixed quantity of shares for every increase in the stock price of a preset amount. Number 3. Retracement additions. A retracement is a brief time during which the general trend in the price of a security is reversed. Even in a bull market, stock values are unlikely to rise continuously. Instead, there are likely to be shorter periods with minor dips, even as the overall trend goes upward. Some investors look for retracements within a bull market and buy at these times. The idea behind this method is that if the bull market continues for security, price in question will shortly rise again, presenting the investor with a lower purchase price number for full swing trading. Full swing trading is one of the most aggressive methods of profiting from a bull market. Short selling and other strategies will be used by investors following the strategy to try and squeeze maximum gains as shifts occur within the context of a bigger bull market. Are we currently in a bull market? A bull market exists when it has climbed 20 or more over its short-term lows since the catastrophic market sell-off during the 2008-2009 financial crisis. The stock market has demonstrated a tenacious bull market increasing strength and reaching new all-time highs. More than 10 years later, despite some sharp pullbacks along the way. That's all for now. If you enjoy what you saw, please hit the like button. And if you're new to the channel, now is a great time to subscribe. After subscribing, don't forget to enable all notifications by clicking the bell icon. Do you want to hear more from us? Feel free to add your thoughts in the comments section. We will respond to you as soon as possible. Thanks for watching this video, and we'll see you next time right here